Warren Buffett just made a move that has everyone talking, but almost no one seems to understand what it really means. Buffett made his fortune doing one thing better than anyone else: buying. For more than half a century, he's been the buyer in a world of panic sellers. That's how he built Berkshire Hathaway into a trillion-dollar empire. But lately, something's changed. For the last 10 quarters in a row, Buffett has been a net seller of stocks, unloading more than he's buying, and building a cash pile that's now more than $340 billion. That's almost a third of Berkshire's entire value just sitting in cash and treasury bills. And to add to that, Buffett tells everyday investors to simply buy the S&P 500 and hold it, but he's done the opposite. He's sold Berkshire's position in that very same index. So what's going on here? Is this a contradiction or a clue? Because when a man who built his fortune on buying suddenly starts selling and keeps doing it for over 2 years, he's not acting out of emotion. He's sending a message about where he believes the market is heading and what he's preparing for next. And if history is any guide, whenever Buffett changes direction this sharply, the rest of us should probably pay attention. Here's what most people get wrong about Warren Buffett's cash mountain. They think he's hoarding money because he's scared of a crash. But that's not how Buffett thinks. He's not hoarding. He's holding. There's a difference. Right now, Berkshire Hathaway is sitting on roughly $340 billion in cash and treasury bills. That's about 29% of everything the company owns. Historically, he's kept around 13%. It's a record not just for Berkshire, but for any large public company in modern history. So why keep almost 1/3 of his company in cash instead of pouring it into stocks? Because Buffett treats cash like a safety net and a springboard at the same time. In his own words from the Berkshire annual meeting earlier this year,
occasionally, very occasionally, but it'll happen again. I don't know when. It could be next week. It could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for.
That's Buffett's way of saying, when chaos hits, I want to be the calm buyer with a shopping list. Think about it like this. Most investors only think about returns. Buffett thinks about readiness. He doesn't know when the next downturn will come. Next month, next year, or 5 years from now. But he knows it will come. And when it does, his cash becomes rocket fuel. Here's another layer that almost no one talks about. The cash isn't just sitting idle. Most of it is in short-term treasury bills paying around 4% interest. In other words, Berkshire's cash is earning roughly $10 to $12 billion a year without taking a single risk. For context, that's more than the annual profits of many Fortune 500 companies. But patience still has a price. Analysts at Barron's estimate that every 1-point drop in short-term interest rates would cut Berkshire's pre-tax income by about $3 billion. Buffett knows that. Yet he's fine with it, because earning a little less for safety is better than chasing bad deals for slightly higher returns. It's the same principle as keeping an emergency fund at home. You don't keep cash because you love low returns. You keep it because it gives you control when everyone else is losing theirs. Buffett's approach to money is like emotional Aikido. He uses market fear to his advantage. When other investors panic, he steps forward. When they rush back in, he steps aside. That's what his cash really represents. Discipline, not doubt. So next time you hear that Buffett's sitting on mountains of cash, don't picture a man hiding from risk. Picture someone waiting for prices to fall into the range where patience pays best. And that brings us to the bigger picture, the market conditions that make waiting feel smarter than spending. If you zoom out far enough, the stock market looks less like a straight line and more like a heartbeat. Up, down, repeating endlessly. That rhythm is what Warren Buffett has been watching for more than half a century. Most investors focus on the spikes and the crashes. Buffett focuses on the pattern between them, because if you understand that pattern, fear stops being scary. It becomes predictable. Think about the past 2.5 decades. We've seen the dot-com bubble burst around 2000. We've seen the real estate collapse in 2008. We saw the pandemic crash in 2020. And every single time, the story was the same. Panic first, recovery later. Each of those crashes felt like the end of the world while it was happening. But go back and look at a long-term market chart. Those terrifying drops are just dips on an upward slope. The average bear market lasts about 1 year, falling roughly 30%. The average bull market lasts more than 4 years, rising almost 150%. That's why Buffett doesn't need to guess when the next crash will come, because he knows it will come, and that it will also end. His job isn't to predict the next storm, it's to make sure he's holding an umbrella when it rains gold. As he likes to put it, when it rains gold, put out the bucket, not the thimble. That's his entire pattern distilled into one sentence. When everyone else freezes or flees, Buffett steps forward with his bucket. When markets rise again and greed returns, he steps back, stacking cash for the next cycle. It's almost boring to watch, and that's the point. Great investing isn't meant to be exciting. It's meant to be consistent. That's the pattern Buffett has mastered. Collect patience during good times, deploy courage during bad ones, repeat for decades. And this is where his 3 timeless lessons begin, the foundation of how he plans, earns, and stays emotionally steady through it all. Let's start with the first one, the lesson that separates investors who survive from those who actually turn out winners: having a clear plan. Here's the first truth Buffett lives by. You don't need his money to think like him. You just need a plan that fits you. Buffett's entire career is built on planning, not predicting. And that's an important difference. Predicting means trying to guess what's next. Planning means deciding what you'll do no matter what happens next. That's the foundation of his success. He often says, you don't have to be smarter than the rest. You just have to be more disciplined than the rest, and discipline comes from a plan that keeps you calm when everyone else is losing theirs. So, what does that look like for ordinary investors? Buffett divides the world into 2 groups: active planners and passive planners. If you're an active planner, you're like Buffett himself. You enjoy digging through companies, reading reports, and finding hidden value. You want to understand why something's cheap before you buy it. You're okay with taking a little more risk because you're confident in your homework. If you're a passive planner, you don't want that stress, and that's perfectly fine. Buffett says it's not improper for passive investors to make a few simple investments. In plain language, he means set your system, keep adding to it, and don't overthink it. For passive investors, the magic phrase is stay the course. That is, contribute no matter what. Whether it's weekly, bi-weekly, or monthly, you invest a set amount automatically. You don't wait for the perfect day because even Buffett can't time that. Instead, you let time in the market do the heavy lifting. Think of it like you're planting seeds in a garden. An active investor picks each seed carefully, studies the soil, and adjusts the watering. A passive investor uses a seed spreader, throws them evenly over time, knowing enough will grow to build a harvest. Both methods work as long as you keep planting. The key is matching your personality to your plan. If you hate volatility, don't pretend to love trading. If you love analysis, don't settle for autopilot. Buffett's genius isn't that he found the right plan. It's that he found his plan and stuck to it for 70 years. And that consistency matters more than perfection. Most investors lose money not because they choose the wrong stocks, but because they keep changing their plans. They buy in excitement and sell in fear, chasing the market instead of following their own system. Buffett's plan is simple but powerful. Stay invested in businesses he understands, hold them through chaos, and keep cash ready for rare moments when the math says buy. You can adapt the same thinking to your life. If you're building a long-term portfolio, define your rulebook before emotions ever enter the room. Decide what you'll invest in. Decide how often you'll add money. Decide when you'll review it. Maybe once or twice a year, not every day. Because once your plan is set, market noise turns into background music. You'll see panic headlines and just think, good, my plan already accounts for this. That's how Buffett stays ahead of the system. His plan isn't built on predictions, it's built on preparation. And once you've got a plan that fits your temperament, you're ready for Buffett's second lesson. Buffett's first rule is to have a plan. His second is to know when to earn from it. Now, when I say earn, I don't just mean making money. I mean positioning yourself so that when opportunity shows up, and it always does, you're ready to act while others freeze. Buffett doesn't try to guess the day markets fall. He just waits for moments when fear takes over logic, because that's when prices disconnect from reality. Those are the moments when disciplined investors get paid for their patience. Here's what that looks like in real life. Back in 2008, when banks were melting down and everyone thought capitalism itself might collapse, Buffett wrote a check for $5 billion to Goldman Sachs. In exchange, he got preferred shares paying 10% dividends, plus bonus warrants to buy more stock later at a discount. Within a few years, that deal made him billions. 3 years later, he did it again with Bank of America. Another $5 billion, same idea. Buffett stepped in when everyone else was running out. His calm earned him ownership and income at the same time. Fast forward to 2020. During the pandemic crash, while panic was everywhere, Buffett's team quietly built positions in Japan's 5 major trading houses: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, about $6 billion total. 5 years later, those stakes are worth almost double, and he recently raised his ownership to around 10% in each. And in 2025, with markets again feeling expensive, he made a smaller but telling move. Berkshire added roughly $1.6 billion to United Health, a steady, profitable business with predictable cash flow. In Buffett's world, that's not chasing hype. That's earning smart, turning patience into performance. See the pattern? When everyone else is reacting emotionally, Buffett turns that emotion into an opportunity. He understands 2 kinds of opportunities: economic and stock-specific. Economic opportunities are broad: recessions, bear markets, moments when the world feels broken. Stock-specific ones are local, when a good company gets punished for a temporary problem. Buffett earns from both. During economic downturns, he uses his cash to buy quality assets at discounts. During stable times, he looks for single stocks that have been unfairly sold off. Either way, the rule stays the same. Only move when the odds are clearly in your favor. Buffett always says you don't find out who's been swimming naked until the tide goes out. That's his poetic way of saying, when the market turns, the unprepared get exposed, and the prepared get rich. Think about it like driving. If you know there's going to be traffic every morning, you don't need to guess the exact minute it'll start. You just leave early. Buffett's cash pile is him leaving early. He's not trying to avoid the jam. He's making sure he's first to move when the road clears. That's how he earns, not by timing, but by being ready when timing happens. You can apply the same mindset even without billions. Keeping a small cash buffer, being patient for value, and saying no more often than yes, that's earning the Buffett way. But all this discipline still depends on one thing, something most investors completely overlook: your emotions. Because no matter how good your plan is, and no matter how much cash you've saved, it all falls apart if you can't stay calm when the crowd loses its mind. That's why Buffett's 3rd lesson might be the hardest, and the most important: how to freeze your emotions. If there's one thing that separates Warren Buffett from almost everyone else in the market, it isn't his math skills or his access to deals. It's his ability to freeze his emotions when everyone else is melting down. One of his famous quotes is, "Be fearful when others are greedy, and greedy when others are fearful." The truth is, emotions are the biggest reason most investors lose money. It's not the market. It's panic, impulse, and overconfidence. The market is like a roller coaster. It only hurts if you jump off in the middle of the ride. Traditional media and social platforms amplify those emotions. When markets rise, the headlines shout all-time highs, and everyone feels unstoppable. When markets fall, they scream crash ahead, and everyone suddenly forgets their long-term goals. Buffett has seen that cycle repeat his entire life, but he doesn't fight emotion with willpower. He eliminates the need for it. His plan and his patience do the heavy lifting. Remember how he keeps nearly 1/3 of Berkshire's assets in cash? That isn't just financial insurance, it's emotional insurance. It gives him the freedom to think clearly when everyone else feels cornered. Because when you're not desperate, you make better decisions. Here's a fascinating fact that proves his point. A study by JP Morgan showed that if you missed just the 10 best days in the stock market over the last 20 years, your total return would be cut almost in half. Why? Because the best days usually happen right after the worst ones. Buffett calls it emotional stillness. It's the art of staying rational while the crowd swings from euphoria to despair. He knows that markets recover, but emotions rarely do. So, how do you apply that yourself? Start small. Stop checking prices every hour. Turn off the news when it sounds dramatic. Review your investments once a month. not once a minute. The less noise you allow in, the easier it is to stay calm. Freezing your emotions isn't about ignoring reality. It's about keeping your logic warm while your fear cools down. Because the truth is, you can't control the market, but you can control your mind. And that control is what separates panic from profit. And now that you understand all three lessons, plan, earn, and freeze emotions, it's time to see how they come together into one simple flow that powers Buffett's long-term success. Let's start with this idea. Your goal isn't to predict the market. Your goal is to be prepared for it. Everything you've learned, the plan, the patience, the ability to freeze your emotions, feeds into that one sentence. If you're a passive investor, your action map is beautifully simple. Pick a reliable fund that tracks the market, like an S&P 500 or a total stock market ETF. Set up automatic investments on a schedule that fits your life, weekly, bi-weekly, or monthly, and never turn it off. Whether prices rise or fall, keep adding. Over time, those small, boring contributions will compound into something remarkable. You won't have to guess when the next crash or recovery hits, because your plan already handles both. If you're a more active investor, your map looks a little different, but the logic is the same. Build a list of companies you truly understand. Watch them patiently. Define what cheap means before you need to decide. When markets get emotional and those names drop into your range, that's when you earn by executing your plan. In both cases, your greatest asset isn't your capital. It's your calm. Every time you resist the urge to chase a hot stock or sell in fear, you're strengthening that emotional muscle Buffett values more than anything else. And building wealth isn't about being fast. It's about being consistent. So if you want to think like Buffett, start there. Keep it simple. Keep it steady. Keep earning through patience, not panic. Want to know the 5 common Buffett patterns that always appeared before every major market crash in the last 5 centuries and are flashing red again right now? Click the video on screen to find out.